And out of that 49% who feels good, 44% of their savings set aside and they feel that it's sufficient, while 37% of the 49% have already set up their retirement planning as well. But the thing here is, this was before the US tariff impact, and this was 2 months later after. In fact, the US tariff impact could include a global trade war, and Singapore may downgrade their full year growth forecast, says DPM Gun. And also, they have warned household and also business owner to prepare for rough waters ahead. And shortly after, just 5 days later, the Singapore recession not ruled out, says the task force. In fact, Singapore government set up a task force to deal with this tariff fallout. So what does this mean for Singaporeans? In fact, slower growth will mean fewer jobs opportunities and smaller wage increment for workers as well. While everyone is focused on the noises, I want to share with you that 99% of the people focus on problem and only 1% of them focus on solution. But our government focuses 1% on problems and set up a task force to focus 99% on the solution. And this is not something that we have seen just recently. In fact, this is what they have been using is in terms of pattern recognition as the focus always on solution. And that's what true leadership is all about. All right. So I want you to feel that the government is actually tackling the problem head on. So how does this matter to Singapore properties? Singapore property price growth expected to slow down given our next big test, says DBS. So the overall property price index actually rose 0.6% in first quarter 25. And this is easing from their previous quarter at a 2.3% growth. And this is April 23. So Singapore property price growth estimated for 2025 to be between 0 and 1% compared to their previous projection of 1 to 2%. So they dropped by 1 to 2 percentage point in terms of projection. And one thing to note is that in the OCR, RCR, and the CCR prices, on the medium outlook, the number of transactions in terms of expected absorption rate in the new home segment, we are saying 8,000 to 8,500 properties to be absorbed or transacted. In the resale segment, we are saying 13,500 to 14,000. And in the landed segment, we are seeing about 1,000 unit transaction. And in the HDB resale, we are seeing 25 to 26,000 transaction. So one thing to note, we've given this revision in price growth, only the suburban area and also the HDB resale segment see a neutral to positive projection, whereas the rest we see negative projections. So will Singapore property continue to attract real estate investors amidst global troubles, right? And this is just in 9 or April 2025. So global interest rates are likely to drop in such a situation, which should benefit real estate investment. So at the bar at the bottom, what we see is investors' intention given these global troubles. You see blue color bar chart here shows the preference in 2025 this year, and gray color is the previous year. In fact, there are 7 different investment vehicles, and for residential income generating properties, we are seeing an uptick of 53% in preference compared to the previous year, which is yield driven. And also residential development, we see a 278% compared to the previous year too. And the headline here by the Business Times in April 16 shared that be long-term overweight on Singapore equities, property as US tailwinds becomes a headwind. So in short, to be more focused on the stock market and property by having a long-term view in this investment. That's what they shout out to the investors as well. So what does it mean? Amidst global chaos, Singapore's stability as a nation attracts global investment. So as US-China tension and tariff shakes market, Singapore neutrality and open economy make it a natural safe haven for many investors. We have strong fundamentals and we are future ready. With AAA rated reserves, low debts and forward-looking policies, Singapore is built to weather global shocks. And property as a resilient store of value, which is wealth preservation, healthy supply with rising demand and ongoing infrastructure upgrades make Singapore real estate a long-term hedge against volatility. So while the world navigates chaos, Singapore is the steady hand. So for prudent investors, this is Singapore's moment to shine once again. And you can take this as though we were facing the previous crisis before, like COVID, right? Many people feel that, hey, Singapore market is going to crash, but guess what? We shine, and this is the next moment to shine once more. So we have been here before, it's not the first time. Singapore home prices are expected to grow 3% on January 2020, and this is pre-COVID. And shortly later, well, in April, after the lockdown happened, there was a market correction from 5 to 8% for real estate prices in Singapore. In fact, Singapore prices are supposed to drop by 1.2%, right? A year of contrast. So by the end of year 2020, we saw that Singapore is likely going to head into one of its worst recessions since independence. In fact, unemployment rate dropped 3.6 or stood at 3.6% as of October 2020, the highest rate since a decade ago. But if we were to move into the end of 2020, which is January 2021, despite the pandemic-induced downturn, we saw that the property market actually strongly rebounded with its first half of the year and did better than 2019, right? In fact, the property market grew by 2.2% for the full year of 2020. This marked effectively the fourth straight year of price increment. So if I were to bring you back 6 months prior, before this was even enjoyed, which is the 6 months growth and whatnot. Over here, the news says that Singapore property home prices likely to rebound only after COVID-19. Okay, but the thing here is that if you look at the lowest downturn or the steep downturn that we have over several crises that we face in Singapore, the very first one was actually the Asian financial crisis that occurred within 97 to 99, and this brought the market down by 37% over 5 quarters here, and then effectively increased 40% over 6 quarters. But we're going to focus on the downturn, right? And the very following one is the global financial crisis, which took place from year 08 all the way to year 09, and that was a 25% down across 4 quarters, and effectively rebounded 62% across 17 quarters. The point to note here is that Singapore private property actually jumped 10.6% the very following year after the lockdown in the whole of 2021. So is this something new, or we are seeing a repeating cycle right here? So these are the property price indexes till the 2021 Q1, and we're going to bring it forward to let you see that 2021 Q4 is actually a 10.6% growth. So the question right here is, were there property cooling measures in place over the years, and how has the market shifted in terms of being prudent to all these crises? All right, so I want to focus on a few cooling measures, not every cooling measures, if not you'll be overwhelmed here. I want to focus on seller stamp duties as well as loan to value, which deter the investors from over leveraging themselves. So the very first one was seller stamp duty that was introduced to curb the flipping mechanism was in February 2010. All right, and that's where we will have to at least hold for 3 years before you could sell. Loan to value was also dropped from 90% to 80%. And the next cooling measures that was introduced on loan to value was in year 2013. After 8 sets of cooling measures before the TDSR, we see the loan to value to drop by 50% for second timers. And the third one was introduced in July 2018. And that's a 5 percentage point drops in loan to value to 75% for first timer and 45% for second timer. So with all these cooling measures in place, my next question here is, are we more volatile today compared to what those precedents of policies were set in, or we are more prudent right now? And the next question, based on historical downturns, how many quarters should we set aside to remain financially prudent when investing for the long term? Because if you look at the quarters here, Asia financial crisis, we were down for 4 quarters. And for global financial crisis, we are down for 5 quarters. So what's the magic number here for number of quarters as holding power if you want to invest under a very volatile or uncertain market? Today's topic is going to be quite heavy because we have a lot of news articles to go through with you to make sure you know that this is not something new. This is something that happens before.